what has to be done. So it's great to have him on board, and we're all confident that under his leadership, this company will scale new heights. I also want to thank Praveen Rao, who did a great job stepping in on August 18th and, making sure everything was running well, and he continues as the Chief Operating Officer. The appointment of Salil has been put to approval of the shareholders with a postal ballot, which has gone out. I also want to deeply thank Rajesh Murthy, President, who's resigned from the board for personal reasons. He has personal challenges that require him to be based in Paris for a longer time. So given the travel he was dealing with, he wants to move on, and we appreciate that. And we all want to place a deep appreciation for his commitment to Infosys for the last 26 years. I had the privilege of hiring him into Infosys in October 1991, and he's been a pillar of this company, and he's a great, warm, large-hearted individual who's always done best for the company. And we wish him all the best in his future endeavors. We also had created some time back something called as a Committee of Directors, consisting of Mr. Ravi Venkateshan and Mr. D.N. Prahlad, to assist the CEO in discharging his responsibilities. Now with the arrival of Salil, who's full-time focused right here in Bangalore, the need for this committee is not necessary anymore. So the Committee of Directors stands dissolved with effect from today. Also, on August 24th, we had mentioned that we would be doing a shareholder consultation, and this consultation process has been conducted. Many of you may have been approached by our people, either in person or through the Rebel thing. And we have got very, very comprehensive, very, very useful feedback from the shareholders. So the board has taken that feedback on record, and we'll endeavor to, continue to provide information and transparency as expected by the shareholders. There are two things I want to also talk about. I think we have just successfully completed the share buyback, and I think I want to give my congratulations to our CFO, Mr. Ranganath, and his team, having done a very complex exercise of doing a buyback across a company listed in 4 different exchanges in Europe, in the US, in India, and I think doing it on schedule, on time. So the buyback has been very successful. And I also want to congratulate the finance team and Mr. Dhareshwar, who have done a great job in signing the advanced pricing agreement with the US Internal Revenue Service. And this again is part of a series of actions they have done on the tax front, which I think will help this company greatly. So I'm sure the finance team will take this forward elsewhere, and it's a great job. And finally, I do want to congratulate the whole management team. This quarter, of course, performance has been very good. And as you all know, December is a difficult quarter because there are a lot of furloughs and leave, and people are in holiday mood and Christmas parties and all that stuff. And in that, to deliver on the revenue, to deliver on collections, is a great contribution of the people under Praveen's leadership. Ravi Kumar, President, Mohit Joshi, President, of course, Rajesh, CFO, and all the other leadership team who made it happen. So I think all in all, the company is well poised now, and under Salil's leadership, I'm sure he'll take it to greater heights. So with this brief comments, are there any questions that you have on board-related matters or on any of the 4 or 5 things I talked about?
Karuna, can you open up for questions?
Participants, if you have a question at this time, you may press star and 1 on your touchtone telephone. So we have a question from the line of Ankur Rudra from CLSA. Please go ahead.
Hi, thanks for taking my question. Nandan, just one question on the board side. In your previous address, you had suggested several initiatives, perhaps associated with reconstitution of the board as well. Given that the first of your tasks has been completed to everyone's satisfaction, do we expect this to continue? And perhaps before you hang your boots again at Infosys, what are the other things you'd like to finish?
No, I think certainly, I think we have talked about it earlier also about the fact that we will continue to work on how we, strengthen the board and so on. So that process is underway, and it has to be done very well, properly and with due diligence and so on. So I think as and when we take decisions in that regard, we'll definitely get back to our shareholders as soon as we take a decision. So clearly, having a board and bringing in new people is one of the challenges we have. I think we also have Salil has to take charge and take it forward, get the company back on the path of growth. We have had a strategy refresh, which he's taking forward. He'll talk more about it. And so we have to complete that part. So I think the number of things that we have to get done, and I'm very confident now that the company is poised for doing those things. So all that I'll be there till all that happens.
Okay, thank you, Investor.
Thank you. Next question is from the line of Edward Keso from Wells Fargo Securities. Please go ahead.
Sorry, I punched in too early. I'm going to come back for the other call. Thank you.
Thank you. We have next question from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Hey, Nandan, Happy New Year, first of all, to the whole management team, and thanks for taking my question. Just one question, and I know you have indirectly replied to that, but just wanted to know, you mentioned when you came that you will be there as long as you are required. So what are those markers which would suggest that, your job is broadly done, and any time frame which you think is there?
Excuse me, this is the operator. So can you hear me?
Yeah, I can hear you.
So can you hear me from the venue, Sandeep Mahindra?
I'm Sandeep Agarwal, I can hear you.
Sure, we request you to please stay connected. So there seems to be audio loss from the management line. Thank you. Ladies and gentlemen, there seems to be a disconnection from the management line. We request you to please stay connected. This is the operator here. Can you hear me?
Please go ahead. We can hear you loud and clear.
Sure, yeah. So, Sandeep Agarwal, you're there in the question queue. If you'd like to repeat your question, please.
Yeah, sure. So, I had a question from Nandan, and it was like, Nandan, when you came to Infosys, again, you said that you will be there as long as required, and I know that you have replied indirectly, but just wanted to know what are those markers which we can, which can kind of suggest that when your job is done, or any kind of indication on the tenure you perceive will be required. Hello, operator.
So can you hear us?
I can hear you, but
no. One moment, please. Sandeep Mahendru, can you hear us? Sandeep Mahendru, are you on the main line? Can you hear us? Sandeep Mahendru, can you hear me?
Karna, I can hear you. Just hold on.
Okay, sure. Participants, we request you to please stay connected while we have the management reconnected. Thank you. Sandeep Mahendru, can you confirm if you are on the main line? Sandeep Agarwal, you can go ahead with your question, please.
Yeah, thanks. So I will once again repeat the third time. So Nandan, when you came to Infosys, you said that you will be there as long as required. So just wanted to know what are those markers by which we can, kind of make out how much of your work is done and how long you may take, or any indication of how you perceive what will be your tenure with Infosys.
Participants, we request you to please stay connected while we have the management reconnected to the call. Thank you.
Ladies and gentlemen, this is the Chorus Call conference operator. Kindly stay connected. We are trying to reconnect the management. Please stay connected. Thank you.
Ladies and gentlemen, thank you for being on hold. We have the management reconnected. Over to you, sir.
First, I would like to apologize for these breakages. Sandeep, over to you.
Yeah, hi. Let me attempt the fourth time. So, Nandan, when you came to Infosys, you mentioned that you will be with Infosys as long as required. So, just wanted to know what are those markers which will suggest that till how long you will be required, or how do you perceive till when you will be there?
No, I mean, that's a difficult question, Sandeep, but as I said, one phase of what had to be done is done. We have brought stability. The board is completely united on the purpose of the company. As Khalil has joined as the CEO, I think, we have, the company is focusing on business and growth. We have done a strategy refresh, and Khalil is taking that forward with his reviews. He's holding Investor Day in April. He's going to meet customers. The board will, we have said that we are looking at how to, bring in more people on the board. So that process is underway, and we'll announce that whenever that happens. So I think, all these things are there, and so whatever time it takes, I'll be there, boss.
Okay. Thanks a lot to everyone, and once again, Happy New Year, and apologies for asking a virus-loaded question.
No. We can ask as many times as you want. It's our thing, because our thing didn't work, so you can ask. Sorry, we made you ask 4 times.
No issues. Thank you, sir.
Yes, we have the next question from the line of James Friedman from Susquehanna Group. Please go ahead.
Thank you for taking my question. Nandan, I was just hoping to ask, so great execution on the capital allocation steward by the board. The company still, by many metrics relative to peers, looks overcapitalized. I was just wondering, what are you going to do with the money? And if you could just describe your priorities, that would be helpful. If you're ready for that. If not, I understand.
Yeah, I think we'll probably have a better sense once Salil does his whole 360-degree evaluation. But as you know, we have said that we will what we are going to do is prepare a capital allocation policy. We talked at up to 70% of distribution and so on. But we will look at the whole thing, and Salil will also look at the M&A and all that, and he'll get back to you by April.
Okay, thank you.
Thank you. Next question is from the line of Divya Nagarajan from UBS. Please go ahead.
Hi, I wish you all a happy new year, and thanks for taking my question. This is again, from a board perspective, what are the steps that have been taken to ensure that we don't have any further disruptions between, in terms of management and decisions being made around...
Excuse me, this is the operator. Divya Nagarajan, can you speak a little closer to the phone, please? We can't hear you.
Yeah, this is better?
Better, ma'am. Thank you.
Yeah, so my question is, what are the steps that have been taken and will be taken to ensure that there is no further recurrences of the issues that we've had in the last year, especially around in certain areas like M&A decisions, employee compensation we've already talked about, but any further when you reconstitute the board, what are we going to ensure that everything functions smoothly going forward?
I think the best proof of that there will be no disruption. There has been no disruption, no? We have seen what has happened in the last 3 months. Everything is stabilized. Everything is quiet. We have gone on with our business. The company has performed impeccably in 2 successive quarters. We have a new CEO. As I said earlier, the board will be expanded at the right time with the right people, and we'll inform you when that happens. The strategy refresh has happened. I mean, I'm not looking at what your question is.
My question is do you feel the need to set up, maybe a committee on the board or something else in the company that ensures that some of the issues that cropped up last year that led to the differences between the management and the founders or board won't occur again?
No, I think that's all past. You're talking about legacy matters. I think now everything is aligned. Everybody's on the same page. Really, the focus is on the future and our business, and that's, our job is to get on with it, which is what we're doing.
Fair enough. Thank you. I'll come back for business questions later. Wish you all the best.
Thank you.
Thank you. Next question is from the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, Happy New Year to the management. Nandan, just one question. I think the senior management attrition is a bit normal to a service industry, especially the IT industry. But off late in the last 5 to 7 years, I think that disruption has cost Infosys a lot. So do you believe or do you have a confidence to say that the second line management setup is now very strong and one can successfully transition whenever such challenges comes?
Oh, absolutely. I think Infosys has a very strong leadership, very deep bench. We have great people at the helm. We have great people who are, also in the next level. So I'm very, very confident. I'm very confident that things will go well going forward. And I think Salil will spend a lot of time on leadership development. So I'm very confident about the future.
Okay. Thank you.
Thank you. With this, I hand over the floor back to the management for the further proceedings. Over to you, sir.
Good evening and good morning, and wish you a Happy New Year. I'm Salil Parekh, Chief Executive Officer of Infosys. I'm joined here by my colleagues Praveen, Chief Operating Officer, and Ranga, Chief Financial Officer, and several members of our leadership team. It is a privilege for me to have this opportunity to lead Infosys. I'd like to thank Nandan and the board for having put their trust in me. I've been in the technology industry for several years, and I've always had a deep admiration and respect for what Infosys stood for. In my first few days in this role, I've been energized by the people I've met here, whether they're individuals starting in the tech world or senior leaders. Each has a real passion for their work. There is pride in being part of Infosys and a deep commitment to its values. The clients I've reached out to have responded with messages that underscore and endorse the strong partnership that Infosys has built with them over the years. There's a real delight in the way they see Infosys and the work we do for them. The market, of course, has exciting opportunities and new areas of growth. Digital disruption today is impacting all our clients as the industries are undergoing massive change. At Infosys, we have a strong foundation of our business, and as you will hear, our Q3 results confirm this. We have over 1,100 clients that trust us, 200,000 passionate employees. We work across a broad array of sectors and service offers. We have a business that's growing with high operating margins. We have exceptional cash generation and a strong balance sheet, and we are now progressing towards stability in governance. Building on the strategy refresh initiated by Nandan, I've launched a review that is structured around market opportunities, client relationships, the people dimension, and our service offerings. Over the next 3 months, I'll meet with several of our clients, partners, and employees and work with our leadership team and the board to validate our assumptions and approach around these elements. In April, I plan to conclude this exercise by outlining our strategic priorities and reconfirming our capital allocation plan. We will have an investor day in April to share this. With a strong set of building blocks and renewed energy to leverage growth in digital, we have an opportunity to build a stronger Infosys in the coming years. I look forward to working with the entire team here at Infosys to be part of that journey. Thank you. With that, now I will request Praveen and then Ranga to comment specifically on the Q3 results and then come back for questions on my introductory remarks plus the Q3 results. Praveen.
Thanks, Salil. Hello, everyone, and wish you all a very happy New Year. I will provide an update on our Q3 performance. Our revenues grew sequentially by 1% on reported dollar basis and 0.8% on constant currency basis. Volumes grew by 1.6% quarter-on-quarter, while realization declined by 0.9% in constant currency terms due to the impact of furloughs and lower working days. However, realization for the first 9 months of FY18 is flat in constant currency compared to first 9 months of FY17. This is due to improvement in our portfolio towards newer and faster growing services and continued adoption of automation in traditional services. This also led to a 1.9% increase in revenue per employee to 53.7K during the quarter. Client metrics were good with 79 client additions, increase in client count and increase in number of clients across most revenue buckets. Share of new services and software improved further to 11.6% compared to 11% last quarter, which is a sequential growth of 6.8%. Our revenues from digital services also crossed 25% of our overall revenues. We plan to publish this metric in the coming quarters. During the quarter, we rolled out compensation increases for our middle and senior management in various geographies. I am pleased to report that our decent performance in Q3 has enabled us to pay the highest level of variable payout over the last 9 quarters to our employees. Attrition declined to 15.8% for standalone operations and to 18.7% for the entire group. Gross addition for the quarter was 12,622 and our employee count crossed 200,000. Operating margins for the quarter were stable despite compensation increases and higher variable pay. Ranga will outline this in detail later in the call. We had 8 large deal wins during the quarter with a TCV of $779 million. When the large deal TCV increased sequentially, our share of renewals within the same was larger this time. Coming to client budgets for 2018, in financial services, there are some signs of improvement in spending trends led by increased discretionary spending. In high-tech and insurance, we expect a lot more focus on optimization of non-discretionary spends, whereas in RCL and manufacturing, we expect higher focus on transformational initiatives. Growth in America was impacted due to furloughs that were witnessed in the December quarter. Coming to few of the verticals and service lines, digital continues to remain top agenda for our clients driven by tech disruptions. The pace of digital transformation will continue to accelerate as consumer behaviors evolve. We are seeing strong demand for digital services across markets with clients investing in customer experience, new commerce models, and digitally connecting the enterprise. Many large transformation initiatives globally are being led by digital. Spending sentiment in retail and financial services industries has improved in digital despite their ongoing structural issues. Growth in financial services was impacted in Q3 due to higher than normal furloughs, budget cuts in few large clients, and transition underway in some large deals which will generate revenues over time. Barring this, we see good traction and stability in spending. Deal pipeline is strong. Our strategic engagements with the clients continue to grow while new services are helping to increase our wallet share. Growth is expected to pick up in calendar year 18. We witnessed strong performance in insurance led by growth from top clients and ramp up of large deals won in previous quarters. There is a demand for core system modernization and increased digital adoption in improving customer experience. Retail and CPG vertical delivered a strong performance in Q3, driven by new opportunity conversions, leading to higher volumes, especially in the CPG sector. Overall, the sector continues to face structural challenges, specifically in US, led by Amazon phenomena. In CPG, there is an increased consolidation, which is also opening up new growth opportunities. Discretionary spends are gaining momentum, led by growing interest in areas like artificial intelligence, retail store operations, cloud adoption, RPA, and analytics. These being funded through spending cuts in support and internal apps work and lights on spending. Clients recognize our strong execution track records and are seeing differentiation through our investments in SCAVA, NIA, and industry partnerships. Growth in manufacturing vertical in Q3 was flat due to furloughs in the US, offset by growth in our European business. Overall sector demands remain moderate, despite some pickup in activities in ERP and infrastructure cloud services due to M&A in the sector. We are focusing significantly on new account opening and deeper penetration to expand our portfolio. Business activity is higher in Europe than US, with European clients undergoing a wave of outsourcing to reset their cost of operations. Client spending is more visible in digital, cloud, IoT at the expense of traditional IT areas. Clients are looking towards digitization of end-to-end processes with stronger focus on mobility, IoT, and back-end systems seamlessly to provide a superior customer experience. Telecom sector is witnessing growing interest in cybersecurity, artificial intelligence, 5G, and cloud computing. Cable companies are prioritizing funding through digital channels via self-services, omni-channels, artificial intelligence, and chatbots. Telcos are focusing on a combination of cost-cutting, productivity improvement, and transforming the core of the network to be virtual and move to real-time provisioning of services. BPM services had another strong quarter with quarter-on-quarter growth of 4.5% and year-on-year growth of 17% in reported terms. Overall demand for BPM services remains moderate due to commoditization and automation, with clients' expectation on automation-related efficiency gains increasing due to increased RPA adoption. However, our ability to bring together vertical-specific solutions and capabilities in a customized manner for industry verticals, together with process and technology competency, is a differentiator. Our win rates in digital and analytics deals in BPO space are strong. Net-net, our performance in Q3 on multiple dimensions, revenues, stable margins, solid client metrics, improving revenue per employee, declining attrition, superior cash generation, and improved operational efficiencies, reiterates our belief that impact of management changes over the last few months on our performance has been negligible. All this, coupled with stability in management, makes us comfortable on our positioning as we move ahead.
Thank you, Salil and Praveen. Hello, everyone, and wish you all a very happy new year. In Q3, the company again demonstrated its resilience in performance on multiple fronts: revenue, operational efficiency, profitability, cash generation, significant closures on tax matters, and most importantly, successful implementation of capital allocation policy. Our relentless focus on improving operational efficiency parameters yielded results in this quarter as well. We had a broad-based improvement in multiple operational efficiency parameters: utilization percent, on-site mix percent, revenue productivity per employee, subcontractor cost as percentage of revenue, leading to a healthy and stable operating margin. Our operating margin for the quarter improved sequentially to 24.3%. I will be providing more details on this shortly. During the quarter, in line with the capital allocation policy announced in April 2017, the company successfully completed its equity share buyback program of 13,000 crores, approximately $2 billion. The company's tender offer to buy back about 113 million equity shares from eligible holders of equity shares received a good response from shareholders. The aggregate equity shares bought back by the company amounted to 4.92% of total equity shares outstanding. The entire funding for the share buyback was done out of the cash on the balance sheet. During the quarter, the company closed significant tax matters, including Advanced Pricing Agreement, APA, with the United States Internal Revenue Service. This agreement covers financial years from 2011 to 2021. I will share more details shortly in this regard. Now let me talk about revenues. Our revenues for the quarter were $2755 million. This is a sequential growth of 1% in dollar terms and 0.8% in constant currency terms. In rupee terms, the revenues for the quarter were 17,794 crores. This is a sequential growth of 1.3%. As compared to Q3 of last year, revenues grew 8% in dollar terms, 5.8% in constant currency terms, and 3% in rupee terms. When we compare revenue growth in the first 9 months of fiscal 18 as compared to first 9 months of fiscal 17, the revenue growth was 6.5% in dollar terms, 5.6% in constant currency terms, and 2.1% in rupee terms. Sequential volume growth for the quarter was 1.6%. As compared to Q3 of last year, the volume growth was 6.2%. Pricing realization for Q3 improved by 2.2% year-on-year in reported terms. On a year-on-year basis, for first 9 months of this year, as compared to the first 9 months of last year, which is a relevant comparison, pricing realization improved by 0.8% in reported terms and was flat in constant currency terms. We ended the quarter with a total headcount of 201,691, which is an increase of 3,251 from last quarter. During the first 9 months of this financial year, the net headcount increased by 1,227 employees as compared to net addition of 5,719 employees in first 9 months of the last year. While our revenues grew 6.5% in the first 9 months of year as compared to the first 9 months of last year, you would notice that the headcount increased by just 1% during the same period. This is primarily on account of lower headcount addition due to higher utilization and productivity improvements. As a consequence, the revenue per employee crossed $53,000 mark this quarter. It improved further to $53,676, a sequential growth of 1.9% and year-on-year growth of 4.8%. Coming to operational efficiencies, utilization excluding trainees increased further to an all-time high of 84.9% as compared to 81.9% in Q3 last year, which is a full 3% improvement. Efforts towards moderation of on-site mix has led to on-site mix decreasing to 29% in this quarter, which is the lowest level in last 11 quarters. On-site mix stood at 29.8% in Q3 of last year. Our focus on optimizing on-site employee costs, including sharper focus on productivity, on-site pyramid, and other cost optimization measures, led to the decrease in the on-site employee cost as a percentage of revenue to 38.3% in the first 9 months of this year, as compared to 39% in the first 9 months of last year. The subcontractor expenses were lower this quarter at 5.9% of revenue as compared to 6.2% last quarter. Subcontractor expenses are driven primarily by higher utilization levels and on-site talent demand. Our operating margins for Q3 is at 24.3%, which increased sequentially by 10 basis points. Cross-currency, including revenue hedges, benefited the margins by 50 basis points. Reduction in professional charges and other G&A expenses helped margins by an additional 60 basis points. This was offset by higher compensation costs and higher variable pay, impacting the margins by 80 basis points. Decrease in pricing realization, net of improved on-site mix, impacted margin by another 20 points, leading to an overall improvement of 10 basis points sequentially. In accordance with the advanced pricing agreement with the United States IRS, the company reversed tax provision of approximately $225 million made in previous periods. Further, in line with APA, the company expects to pay approximately $233 million of taxes due to the difference between the taxes payable for prior periods as per the APA and the actual taxes paid for such periods. This amount is expected to be paid over the next few quarters. The reversal of tax provision of $225 million had a positive impact on the consolidated EPS for the quarter ending December 31st by approximately 10 cents. As you know, the U.S. tax reforms has reduced federal tax rates for corporations from 35% to 21% effective January 1, 2018, amongst other measures. During the quarter, December 31st, 2017, this has resulted in a positive impact of about $27 million on account of tax credits pertaining to deferred tax liabilities on branch profit. Healthy cash generation continued during the quarter. Cash provided from operating activities as per IFRS consolidated was $657 million. Free cash flow, which is operating cash flow less capex, for the quarter was $593 million. For the first 9 months of FY18, free cash flow was robust and increased by 23% over the first 9 months of last year as compared to the revenue growth of 6.5% in the same period. Cash and cash equivalents, including investments, stood at $4,538 million, which converts to approximately 28,987 crore rupees. During the quarter, the company paid out interim dividend of $526 million and paid out 13,000 crores, approximately $2 billion, towards share buyback. Also, during the quarter, the company received cash refund of approximately $100 million or 643 crores due to favorable orders and audit closures in India. DSO for the quarter decreased by 1 day to 70 days compared to 71 days last quarter. Capex for the quarter was 64 million and rupees 15%. With that, we open the floor for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. First question is from the line of Anantha Narayanan from Credit Suisse. Please go ahead.
Thank you, and wish all of you all a happy new year and a warm welcome to Salil as well. I had 2 questions. My first question was addressed to Salil. We do appreciate the fact that you just spent a few days at Infosys, but based on your discussions during the recruitment process and based on what you knew of Infi from your Capgemini days, do you foresee any area where significant investments need to be made?
Hi, Ananta. Thank you for that. As I said, the time spent over the next 2 or 3 months is going to be around the 4 pillars which will build upon the strategy refresh that Nandan has launched. Coming out of that will be the set of strategic priorities that we want to drive. And we will hold an investor day in April to talk about it. At this stage, I've not developed any clear view in the few days I've been here in terms of the question you ask for investment cases.
Okay, that's probably fair. And for my second question, has Rajesh's portfolio been reassigned?
At this stage, the portfolio, I will work directly with those areas. Over the coming days and weeks, we will find a way to more efficiently distribute it.
Okay. Thank you and good luck, Salil.
Thank you. Next question is from the line of Pankaj Kapoor from JM Financial. Please go ahead.
Yeah, hi. Congratulations on a decent quarter and welcome, Salil. My first question is on the implied guidance for the next quarter that seems to be quite broad for the fourth quarter. So I'm just curious why we have given a broad range. Is it something to do with the environment or any client-specific situation which makes you a little uncertain on the near term?
Hi, this is Ranga here. If you look at the first 9 months revenue growth as compared to the first 9 months of previous year, we have grown at 5.6% in constant currency, and our guidance is 5.5 to 6.5. I think we are focusing on Q4 execution. And to just answer your prior question, I know there are no specific client concerns that we are foreseeing at this juncture.
Okay. And Ranga, if you can give some color in what kind of tax rate we should presume for the next couple of years, given the APA as well as some of the tax benefits that you mentioned can come to us post the changes in the U.S. taxation.
So let me first address the APA part. As you know, as we announced earlier this week, APA provides a better predictability because the methodology of both allocating the revenues and computing the pre-tax income is laid out. So as we said in the earlier press release, we expect the overall effective tax rates to be lower about 100 basis points on account of APA for the periods covered under APA, which is 2011 to 21. Now, coming to the broader U.S. tax reforms, there are multiple elements in the tax reforms. While we have done a very preliminary assessment at this stage, but overall we feel that it is going to be neutral in our case.
Got it. Thank you and all the best.
Thank you. Our next question is from the line of Edward Caso from Wells Fargo Securities. Please go ahead.
Hi, thank you. Your utilization has been running record levels here. How high do we raise the bar? I mean, how much more is there to go? And Salil, welcome.
Hi, this is Ranga here. As you know, utilization, if you look at last couple of quarters where we have been focusing, it has gone up significantly, as you rightly pointed out. We are at 84.9. Same quarter last year was 81.9, so full increase of 3%. But from here on, the runway balance, I agree, is quite limited. And that's the reason why we are also, in addition to utilization, are focusing on other elements which we had talked about. For example, earlier quarters, we had talked about on-site mix moderation. And if you look at over the last 3-4 quarters, the on-site mix has come down from 30% to 29%. So I think, and similarly on the on-site employee cost as a percentage revenue for the first 9 months has come down to 38.3 from 39. So we're looking at multiple levers, but to specifically answer your question, yes, on the utilization front, certainly the runway is limited.
Great. And I had a question about access to people in the United States. I believe you're sort of working still with the fresher model in the U.S. to a large part. How is that going? Are you able to access people given the very tight labor market for IT professionals in the U.S.? Thank you.
This is Praveen here. As you are aware, we have committed to recruiting 10,000 people over the next 2 years. And in the last 2 quarters, since we made that announcement, we have made good progress. We have been going to tier 1, tier 2 colleges as well as community colleges, and we have had a fair amount of success in recruitment. So we don't see that as a challenge. We have also setting up innovation and technology hubs. We have already inaugurated the first one in Indianapolis. We will launch one shortly in Raleigh, North Carolina. So we'll probably over the next few quarters, we will identify 2 or 3 more locations to do that. So our U.S. talent plan is really on the way and kicking well, progressing extremely well. And at this stage, we are not seeing any significant roadblocks.
Great. Thank you.
Thank you. Next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Hi, good evening. Thanks for taking my question and welcome, Salil. So I had a question on the client metrics. So if I look at the top 10 and top 25, it seemed to decline in this quarter. So I mean, should anything be really read into this?
Hi, this is Ranga here. I think, the sequential quarter basis, there will be some changes. But I would encourage to look at the 9-month over 9-month metrics or the year-on-year metrics. For example, if you look at the top 25 accounts, if you look at, they grew 4.8% quarter-on-quarter compared to the last year. That is Q3 of this year versus Q3 of last year. So I think, and also Q3 typically has furloughs. Some of our top clients have certain furlough impacts during the quarter, which can, in the short term, can distort these numbers. But overall, I think a better indicator, in our opinion, is to look at the YOY change. So YOY top 25 has grown at 4.8%.
Sure, that's helpful. But if you can talk about if we're gaining share within our top accounts.
Yeah, this is Praveen here. I think in many of our accounts, we are definitely gaining shares. There is a lot of effort in terms of mining accounts better. And if you look at the last few quarters, we have had significant wins in large deals as well, and a good percentage of them are rebates and renewals and so on. There have been a lot of focused efforts in the last few quarters, and in most of the accounts, we are in the top 2 from a market share perspective.
Sure. Thanks and all the best.
Thank you. Next question is from the line of Arvind Ramnani from Citibank. Please go ahead.
Hi, this is Arvind Ramnani from KeyBank. Salil, welcome to Infosys. We are pleased that Infosys was able to recruit you. You have terrific background and reputation. And I know it's probably premature to comment on your priorities at Infosys, and you'll give us an update in April. I'm sure you certainly have a view of the industry given your background. So my question really is, what is your view of the IT services industry, and specifically, what are the key opportunities and risks, and how do you think the industry should address these risks?
Thank you, and thank you for the question. I think with respect to the sector and the industry, the good news is there's significant areas of growth opportunity today in the market. As you know well, these areas are broadly classified under the name digital, so they cover a lot of different things for different people. So the areas of data and analytics, IoT and industrial internet, the whole area of cloud, from SaaS to hybrid cloud management to the migrations, digital customer experience, security, AI, machine learning. So these are massive areas of opportunities for growth in the sector. In terms of areas where there's challenges, I think the overall sector is shifting to a much more business-driven tech agenda. The buyer is not just the CIO, but it's also the business user. And so many of the ways and means of interacting with clients needs to evolve to look at that. So that's my perspective on the sector. It's an exciting sector, but there's a transformation in the sector. And the players in the sector need to have agility to be playing in these new areas.
Thank you.
Thank you. Next question is from the line of Keith Bachman from Bank of Montreal. Please go ahead.
Hi, I'd like to ask a similar question to the past one, but I'd specifically like to focus on gross margins. If you look across the IT services industry, with very few exceptions, including Infosys, gross margins continue to erode and go lower. and I'd like to understand your perspective on what's the opportunity for the Indian-based providers to, at a minimum, stop the gross margin erosion, and how you think the mix plays out as you're trying to increase the amount of business from digital, which I think near-term erodes margins. How do you balance that new market opportunities for the Indian-based providers? So the real question is, can you talk a little bit about gross margin issues in the industry and how the Indian-based providers combat the erosion to the gross margin line?
Hi, this is Rangai here. Yes, you're right. I think the gross margin declines have been quite visible. If you look at our cost structure, as you know, 80% of our operating expenses, even the cost of revenue expenses, is the employee cost. Now, if you were to slice that employee cost, 40%, in our case, close to 40% of our revenue is from on-site employee costs. Add to that another 16.5 offshore, so total 56.6. So the key thing is how do we ensure that for the on-site costs that we incur, what are the corresponding billing rates concomitant to the costs that we incur, which essentially means going back to the pyramid. Now, one way to look at it is, hey, here is the traditional IT service, here is the pyramid, can I optimize the pyramid, make sure, for example, right now we are hiring the freshers in the United States as part of the pyramid in the on-site. Earlier we used to have on pyramid structure with freshers intake at the bottom of the pyramid, only in India. So there are some opportunities coming, and even the propensity of the clients to accept fresh graduates on site is slowly picking up. So that's one way to look at addressing the on-site employee costs. The second way, which is also more sustainable, is really, as you pointed out, how could we price our new services, including digital, at higher price points? As you would notice, even this quarter, sequentially, our new services grew close to 7% sequentially, 7 times the regular company growth. And it's almost now 9.9% of our revenue. Now, if this robust growth is coupled with higher price points for these, would also be beneficial to address the gross margin. So in summary, I think we need to look at the revenue mix, how much of that revenue mix is coming from, the incremental revenue mix comes from the new services, which are more profitable. And at the same time, how do we address the pyramid as well as the cost structure issues in the core IT services? We need to do both hand in hand. So that's really the way to look at the gross margin.
Okay, thank you very much. I look forward to your April analyst event.
Thank you. Next question is from the line of Ashwin Mehta from Nomura Securities. Please go ahead.
Hi, thanks for the opportunity and welcome, Salil. I had one question on BFSI. One of your peers indicated that there's near-term uncertainty on BFSI driven by clients finalizing their digital architecture and secondly deciding allocation between in-house and outsourced. So you seem to be sounding much more positive near-term in terms of BFSI. So what exactly is driving this optimism? Is it deal flow? Is it portfolio differences? Some color would be helpful.
Hi, this is Mohit. So if you look at it, the insurance growth has been very strong. I guess your question is more on banking piece. And what I say is, while there are individual clients, right, the individual clients where you may have ramp ups or ramp downs, but overall, the overall spend position is stable. And while we expect that there will be some sort of movement, right, from more of regulatory spend to more of growth-oriented spend, but we're quite comfortable with the position that Praveen had shown. That from a calendar year 18 perspective, we see spend as being stable for the sector. in certain sectors or in certain subsectors, like in regional banks, for instance, we've seen the fact that clients are having to do a lot of catch-up, so they're investing significantly more in terms of their digital or their mobile strategy. In some other subsectors, like asset management, for instance, where about a year and a half ago we've seen fairly significant cuts. We've seen those sectors come back comparatively from a spend perspective. So the overall picture is not as hazy or as negative as it was a year ago. And if you've seen, from our performance in Q3 itself, compared to our peer group, we have done well. Though obviously, it is mixed, right? It is mixed across subsectors and geographies.
Okay.
This is Praveen here. I just wanted to add, I just wanted to reiterate that while in quarter three our performance was muted, particularly in banking space, but that was primarily due to higher than expected furloughs and slowness in ramp up of some of the large deals that we have won in the past. Our competitive positioning in this space is pretty strong and reflected in the kind of growth we have had in last few quarters. And as Mohit said, we remain positive on this segment, and we expect to see calendar year 18 spend come back and much better than what we have seen this year.
Okay. And just one more. In terms of wage hikes, you've had pushbacks in the cycle this year. Going into the next year, what is the wage hike cycle that you're looking at?
So we are yet to start thinking about next year. Right now, our focus is on executing on quarter four. But sometime during this quarter, we'll start looking at next year on the overall thing, revenues, the costs, and wage hikes, and etc. So we'll probably be in a better position to comment on it at the beginning of April.
Okay. Thanks a lot and all the best.
Thank you. Next question is from the line of Radio George from JP Morgan. Please go ahead.
Yeah, thank you for the opportunity. I think all my questions have been answered. A very warm welcome to Salil. Yeah, that's it. Thank you.
Thank you.
Thank you.
Next question is from the line of Brian Bergen from Cowen. Please go ahead.
Hi, thank you. Salil, congratulations. I wanted to ask on the large BFS deals that give you a better 2018 calendar outlook. Can you comment on the type of deals that those were, including the kind of activities that you're doing there, whether they're net new work, whether they're more traditional or digital engagements?
So look, I think from a BFSI perspective, right, like I said, there is a pivot that is happening now, more from regulatory-oriented spend to more a digital-oriented spend this year, right? So that is one key theme. The second theme is if you look at the fact that we have platforms as well. So whether you look at McKinsey or you look at Finacle, there's a significant demand for platform-oriented businesses. So that's the second piece. And the third piece is the overall sector sentiment, right? There are individual banks that are still looking at cost cuts, but the overall sector sentiment is positive. And that is based, that reflects the commentary that we've made today.
Okay. And so, understanding you just started, can you comment your personal views on M&A as an avenue for growth in the current digital services environment?
Again, the view I've taken is take the next 2 or 3 months to dig into relook at our strategic refresh along the 4 dimensions: the markets, clients, people, and service offerings. Given the environment and given that we have a very strong balance sheet, we will look clearly at M&A as a very strategic opportunity, but no decisions have been made. We're starting to evaluate that carefully to be further sort of prioritized around the April Investor Day.
Okay, thank you.
Thank you. Next question is from the line of James Friedman from Susquehanna Group. Please go ahead.
Hi, thanks for getting me back in here. Ranga, I just want to mention that was a great response that you had with regard to employee costs to the earlier question. I had a more straightforward question, Ranga. I didn't hear you say it, but is there some change in your tax rate assumption going forward based on the dynamics in the U.S. tax market?
Hi, this is Rangai here. I think, what I was commenting earlier, or a similar question earlier was, on account of signing of our advance price agreement, we expect our overall effective tax rate to be lower by about 100 basis points for the period covered under APA, which is 2011 to 21. Coming to the second part of your question on the U.S. tax reforms, there are multiple elements in the U.S. tax reforms. One is, of course, the reduction in the tax rates, but several others. We have made preliminary assessment of the impact, and based on the preliminary assessment, the impact is neutral for us.
Got it. Here, I'm just writing that down. And then, Praveen, I wanted to ask you one as well. With your prepared remarks, you commented on the improved dynamic in European outsourcing. Not a new narrative, but clearly there's results here for it. Where are we in that journey, Praveen? How do you see that as we move forward for the next line of sight in European outsourcing? Thank you.
So I think when you are looking at what's happening in the market, there is tremendous focus by clients across industries in terms of transforming their businesses and investing in newer areas. So this is actually pressurizing them to look at ways and means to cut costs and reduce the cost in one side of the business. And this is actually translating into large deals. And as compared to North America, in Europe, they have been probably not as aggressive as North America. And so that's actually today translating into a much more aggressive push for vendor consolidation, large deals, and so on the run side of the business, so that any savings they can throw back on changing the business. So that is the phenomenon we are seeing, and we have been fairly successful in tapping to this opportunity and converting a fair amount of these deals that have come our way.
Thank you very much. All the best.
Thank you. Next question is from the line of Divya Nagarajan from UBS. Please go ahead. Divya Nagarajan, your line is unmuted. You may go ahead with your question, please.
Hi. Just a clarification on the demand outlook. Can you hear me now?
Yeah, we can hear you, ma'am. Thank you.
Yeah. So on the demand outlook, could you just help me understand between the BFS segment and the retail segment, where do you have greater confidence and outlook of a recovery? Is my understanding correct that you're more confident about BFS over retail, or could you just correct me if I'm wrong, please?
I think we are fairly confident about BFS being, again, better than what we have seen this year and spend coming back. We have had a good quarter. On the retail and CPG side, we have had a good quarter after several quarters. And primarily driven by a lot of opportunities in European retailers and CPG companies, and less so from North America. But when you look at what's happening in this space, given all the structural changes, there is a lot of investments going on. And our belief is if we are able to bring our capability to bear, we should be able to capture some of the investments that are out there. Unlike BFSI, in my mind, it's probably a little bit early to comment whether this trend will continue for retail, but we are hopeful at this stage.
Got that. Thank you, and all the best.
Thank you. We take the next question from the line of Dave Conning from Baird. Please go ahead.
Yeah. Hey, guys. Thanks for taking the call. And I guess, first of all, just to make sure we're clear on this, in Q4, other income should come down maybe a third sequentially or so because of the cash you just used. And then what should the share count be in Q4, just so we get that right?
Yeah, on the share count came down by 4.92%. That was exactly the buyback. And if you look at our fact sheet, we have provided the weighted average shares post buyback. And coming to the first question,
Yes, to some extent, the other income is impacted by the interest income that we earn from the balances. So that is something, we paid out $2 billion and also the interim dividend during the quarter. So to that extent, yes, the other income comprising interest income can see some change.
Okay, thank you. And I guess secondly, one more thing on the tax rate. If we add back the $225 million to Q3, your tax rate this quarter would have been 30%, which is the highest in many years. Is that the normal tax rate now to kind of start basing everything off of? Like, was there something that's changed a little bit to make it higher now on an ongoing basis than it's been?
No, actually, on an ongoing basis, as I said, overall effective tax rates last couple of quarters has been 28-29 range. This particular quarter, apart from this, as you know, we have disclosed in the financial statements, our subsidiary BPO paid dividend to us. So there is a dividend distribution tax, though that can be offset against our dividend distribution tax. But technically, for accounting purposes, we have to show it as the tax expense.
So how should we think about though? Obviously there's a lot of moving parts between tax reform, the APA benefit and stuff. Does that all aggregate to a pretty normal ongoing tax rate around 28%?
Well, I think coming to the APA, as we have disclosed earlier, because of the APA, we expect our overall effective tax rates to come down by 100 basis points for the period covered under the APA, which is 2011 to 21. Now, we have also made a preliminary assessment of the U.S. tax reforms and the measures approved under the U.S. tax reforms. Our preliminary assessment indicates that the overall impact is neutral for us. So there are two parts. The tax reform impact is neutral. The APA is about 100 basis point reduction in the overall effective tax rates for the period covered under APA.
Okay, great. Thank you.
Thank you. Next question is from the line of Ravi Menon from Elara Securities. Please go ahead.
Hi, thank you for the opportunity and welcome aboard, Salil. While it's too early to ask from you regarding Infosys strategy, but since you've been a long-term industry participant and in a very senior role, in your view, have Indian IT firms been slightly slow to adapt to the technology shift underway? And do you think that there is a change required in the model itself as new technology requires a different kind of skill set profile, deep technical expertise in multiple elements of the stack, good domain expertise as well? And would you view these as not being compatible with the traditional pyramid model for Indian IT services?
Thank you. I didn't catch the second part of the question, but let me start with the first. I think it's difficult to characterize all companies, whether they're from India or from other geographies, in a particular grouping with where they stand on the transformation journey. There are different nuances of different companies. In general, in the market, I think there's a lot of work that's going on in different components of the digital spectrum. As you know well, there's a whole component around the marketing and interactive side. There's a component around the industrial internet, and there's a component around cloud and its different iterations. And different companies across the sector, not just from India or others, have strengths that have developed in specific areas. That's the way, at least, I've seen how the industries evolve. So I don't have a view of one grouping being in a position which benefits or does not benefit. And the second part of your question I didn't catch. If you could repeat that, please.
Yeah, the second part was, is there a change required in the model itself as new technology requires a different kind of skill set profile with deep technical expertise in multiple elements of the stack, good domain expertise as well. And do you think that this is not really compatible with the traditional pyramid model for Indian IT?
Well, first, I think the pyramid model applies to almost every business I've seen within the IT sector, whether it's from India or from anywhere else. In general, I think the skill sets that are needed in some of the newer areas require that there needs to be some level of reskilling, or indeed, if you're recruiting from college, that type of skilling that needs to come in. So those implications, I think, are independent of where the company is from. It depends on the portfolio that the company has in terms of its current service offer. So again, the pyramid, I think, approach at least applies to most companies that I'm familiar with in the sector.
Great, thank you. And Praveen, just a quick question. In the press conference, you mentioned that Infosys is repositioning NIA with some new thinking. Could you please elaborate on that statement?
Can you repeat the question, please?
In the press conference, you mentioned that Infosys is repositioning NIA with some new thinking. Could you elaborate on that?
Yeah, we have had, as you're aware, we have had good success in NIA over the last few quarters. But at the beginning of last quarter, when we did the strategy refresh exercise, we looked at all aspects of our business, including NIA, on what is working and what is not working. And one of the opportunities we found in NIA was right now we are positioning it more as a horizontal solution. We felt looking at what was happening and the differentiated position of NIA, we felt over a period of time our ability to monetize would be much better if we are able to build vertical solutions on top of NIA. So that is a strategic shift that we have done, and it's been probably a quarter since we have done that, and we are focusing on executing on that.
Great, thank you, and best luck.
Thank you. Next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, so I have a question which probably Praveen or maybe Salil can as well add. So first of all, warm welcome to Salil and best of luck for your new role. And thanks for giving me the opportunity to ask a question. So my question is little, bottom up. What I'm trying to understand here is that with Europe firing better than earlier and digital doing well, BFSI looking optimistic, retail looking good, and energy with oil prices going up, and again, communication probably is not worsening further. Will it be safe to say that CY18 looks much more promising than CY17, and probably the worst of the growth is behind? I'm not asking for any guidance, but just trying to understand.
It's perhaps too early to comment on that. As I said earlier, right now our effort is to make sure we execute on quarter four. For us, in the last few years, quarter four has been an unusually soft quarter, and this time we want to make sure that we exit at a decent rate, and which will help us going forward. At the same time, in this quarter, we'll have the benefit of Salil getting into details about the strategy refresh exercise, as well as there's also a time when we also step back and take a look at the pipeline and the future. So April is perhaps the better time for us to respond to this question.
Okay, thanks. That's very helpful.
Thank you. Next question is from the line of Mukul Garg from Haitong Securities. Please go ahead.
Thanks for giving me the opportunity, and a very warm welcome to Salil. Ranga, the first question is on the on-site mix, which you have highlighted as one of the drivers which can be further improved. Should we look at this on a near-term basis, or do you think there is space for improvement even on the medium term, especially on the back of the upcoming hiring which you have committed in US over the next 2 years?
Hi, this is Ranga here. Yes, over the last couple of quarters, we have said that we are focused on on-site mix, and it has moderated from the level of 30% to 29.8 and 29.4 last quarter, and now 29. However, the on-site mix is, as you rightly said, is also a is also a derivative of the business mix. And for example, certain service lines like, for example, testing or infrastructure management make themselves more amenable for on-site mix moderation. Typically, they have a larger component of offshore. However, some of the new services as well as the consulting and other services are typically on-site heavy. So I think the business mix change is one factor if you look at the broadest level, which can have an effect on the on-site mix. But more specifically, what we have also done over the last couple of quarters is to look at more granular at the service line level and also look for opportunities for the on-site mix moderation. And there the focus primarily has been on the fixed price projects because in case of a T&M, when we try to moderate the on-site mix, there is the impact on the revenue is quite linear. Whereas in case of a fixed price projects, the moderation of on-site mix through productivity and others do not linearly impact the revenue. So I think we need to work on multiple components here. So that's what we have done. So we don't want to kind of give any specific target for the medium term or something, but we'll continue to work on it.
So maybe if I can ask this question in a slightly different way, you are planning to hire about 10,000 employees in US over the next 2 years, and if you look at your recent net hiring levels, they do not suggest a significant ramp up of hiring in India itself. So won't that work against optimization of on-site mix further in the medium term?
No, I think if you're referring to the hiring part necessarily not means always net headcount, right? It is also a churn of people, visa-dependent people with visa-independent people. So to some extent that will also address the replacement of current people on certain projects. It's not necessarily mean that the entire 10,000 is totally incremental to the existing. So I think there are a couple of pieces there as well. So overall, our focus on on-site mix is a combination of business mix as well as in the FP projects in the current service portfolio by service line. How do we address this? I think that will be the result of these two elements.
Understood. And if I may ask one question to Praveen. Praveen, you mentioned that digital is now crossed 25%, and you will probably give us more breakup about the growth going forward. But can you help us understand what you are seeing there in terms of size now? Digital has been one of the factor areas in the market for a while now. So have you seen digital actually scaling up and becoming large business line by itself in terms of individual orders? We recently heard one of your larger peers talk about a reasonably large digital deal win. So are you also seeing something similar?
As we said earlier, our share of revenue from digital has crossed 25%. We will probably start reporting that in the next coming quarters on an ongoing basis. In the last couple of quarters, we have started talking about new services and software share of revenue from that. And that is a subset of digital. And as you have seen this quarter, it has grown by 6.8%, and today it's about 11.6% of our revenues. So that is a kind of growth. While overall we have grown at 1%, growth from new services and software has been about 6.8%. So that is a kind of impact we can see. And digital is a common theme across industry verticals because everywhere we are seeing clients looking at new business models, improved customer interface, digitization, and so on. And the definition of the digital also in some sense is very broad. So one part of the digital definition is about cloud. And if you today look at any large deal, there's an element of cloud in that. And if you use that hypothesis, then there are already, in the past also there have always been many large deals with a significant component of digital in that. So I would not like to comment. We continue to see traction. We continue to expect increased momentum in digital across verticals. But I would not like to really comment on the size because On the basis of definition itself, we have already seen large-size digital deals.
Understand. Thanks for answering my questions. That's all from my side.
Thank you. Next question is from the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, thanks, and welcome, Salil, and all the best. Just the question is in terms of the 4Q guidance. So if I look at the higher end, it is 3.1% Q-on-Q growth. While last 4 years, if you look at, except for 1 year, 3 quarters in 3 years, we had a sequential decline. So what gives you a confidence to retain your higher end of the guidance at 3.1% this time? So what could be the tailwinds which can result into some amount of optimism or breaking the jinx?
No, I think we should not read too much into this beyond the fact that only one fact which I would like to mention here is, if you look at the first 9 months of this year, the revenue growth as compared to the first 9 months of previous year, in constant currency, we have grown at 5.6%, and our current guidance is 5.5 to 6.5. And as you know, we had reduced the guidance last quarter. So I think right now, as Praveen had mentioned earlier, the deal momentum that we have seen in the earlier quarters, we are focusing on ramping up some of them. And I think the focus is clearly to have good execution in Q4. At the same time, we are also very, as you rightly mentioned earlier, we are very much aware of the fact that the exit rate of Q4 is important to live away. And that will really be important from the FY19 point of view. So we are all working towards the execution.
Okay. Just the last question on the large deal pipeline. Some of your peers as well as industry consultants says that the pipeline is robust and the decision making or conversion of the pipeline is actually accelerating or increasing. Do you also witness the same, and is it broad based across industry segment?
This is Praveen here. The pipeline is strong. I agree with that assessment, but the decision cycles continue to be strong. Continue to be long. It takes anywhere from 6 to 9 months from the beginning to close on an average. So we have not seen any accelerated decision making. And by and large, it is broad-based. Obviously, you are seeing a lot more. You have seen in the past a lot more large deals in the ECS space and in the FX space. We have seen pockets in manufacturing and RCL. And we don't see any pattern in that. It really depends on when deals come up for renewal and renewal cycles and so on.
Okay. Thanks and all the best.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand over the floor back to the management for your closing comments. Over to you, sir.
Thank you. This is Salil. Thank you everyone for joining this call today, and thank you for the warm welcome. As you have heard, we have had a strong performance in Q3. All of our metrics indicate the underlying business is in good shape. Overall, the fundamentals of our business, growth, operating margin, and cash generation are really in a healthy position. We also have a pristine balance sheet, which has been used in the past and we will continue to use in the future as we evolve the capital allocation policy. Our governance now is stable, and with that we now look at our strategic priorities that we'll lay out at the April Investor Day. That's what I wanted to share with you from our call today. Overall, as a company, we have all of those elements coming together. Look forward to meeting with several of you at the April Investor Day, and thank you again for joining in.
Thanks everyone for joining us on this call. We look forward to talking to you again. Have a good day.
Thank you very much. Ladies and gentlemen, on behalf of Infosys, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.